Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
Yeah, we have a really fascinating one lined up today.
Today, we're breaking down one of the most interesting companies on the market, the global payments giant, Mastercard.
Right, which is trading right at $500 a share right now.
Exactly. And with a massive $442.2 billion market cap as of today, June 28, 2026. On the surface, it's a fantastic business with a really powerful brand. But the real question for us as long-term investors is this. Are there hidden cracks in the fortress that the market is ignoring?
Right.
I mean, are they still a compounding growth engine? Or is the company secretly transforming into a slow-growth, heavily regulated utility? That's what we're here to find out.
That's a huge topic. Before we dive deep, a quick heads up for the audience.
Right, so if you're looking to invest, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments.
Now let's get into it. Pillar number 1, the business model.
So to really understand the threats against a giant like Mastercard, we first have to, pop the hood and understand how the underlying machine actually makes its money.
Right, which is built on something called a four-party network.
Exactly. Let's break that down for everyone. Imagine you just go buy a $5 coffee. You essentially have 4 players. You have the cardholder, that's you, the issuer, which is your bank, the one that actually gave you the physical card.
Yep.
Then you have the acquirer, which is the coffee shop's bank, and finally the merchant, the coffee shop itself.
And Mastercard just sits right in the middle of all that.
Right in the middle. They just connect your bank to the coffee shop's bank.
Yeah.
But here is the absolute most crucial detail of this entire setup. Mastercard takes 0 credit risk.
Yeah, and that distinction is, well, it's everything. I mean, they are not a bank.
Right. They don't lend you the money.
Exactly. If you max out your credit card and completely default on your payments, Mastercard doesn't lose a single cent.
Wow. So the issuing bank takes that entire loss.
100%. Mastercard is purely the digital highway connecting the banks. They make their money by charging what's called an ad valorem fee.
Which is just a fancy way of saying a percentage fee, right?
Yeah, basically just a percentage of the total purchase price. Plus, a tiny flat fee for processing the data every single time a swipe, a click, or a tap happens anywhere in the world.
It's literally a toll booth on the world's busiest highway.
It really is.
And it's protected by an incredible moat. It's built on two-sided network effects. I mean, Mastercard currently have over 3 billion cards in circulation globally.
3 billion. It's almost hard to comprehend that scale.
It's massive. And it creates this insurmountable chicken and egg problem for any new company trying to compete.
Right, because a merchant has to accept Mastercard because 3 billion people carry them.
Exactly. And cardholders carry them because literally every merchant accepts them. You just can't start a rival network from scratch because nobody will join it unless everyone else is, already on it.
Which creates this structural fortress. It's a classic Lollapalooza effect. You have the convergence of 3 massive forces pushing the business forward all at once.
Okay, let's walk through those 3 forces. So what's the first one?
First, you just have ubiquity and behavioral lock-in. People simply prefer the frictionless interface of tapping a plastic card or, double-clicking their digital wallet. It's pure habit at this point.
Yeah, I barely even carry cash anymore.
Same. And the second force is near-zero marginal cost scale economies.
Wait, let me stop you there because we should really translate that for everyday investors.
Yeah.
Near zero marginal cost basically means that once the digital network is completely built, processing the very next transaction costs them practically nothing, right?
Precisely. Think about it. If they process 1 billion transactions today and then 2 billion transactions tomorrow, they don't have to go out and build twice as many factories.
Or hire twice as many workers.
Right. The infrastructure is already there. So the revenue from that second billion transactions, it feeds almost entirely straight into pure profit.
Which is an incredible business model.
And that leads directly to the third force in this Lollapalooza effect, which is the inflation float.
Yeah, this is the one that really blows my mind.
Oh, it's brilliant.
Because they charge an ad valorem fee. That percentage of the transaction size we talked about, they act as a direct royalty on global inflation.
Yep.
If the cost of a gallon of milk goes from, say, $3 to $4, the total dollar amount of the transaction just goes up. Mastercard automatically gets a bigger cut.
Without having to lift a single finger.
Exactly. They don't spend a dime to combat those higher costs themselves. They essentially get an automatic raise just because the broader economy is experiencing inflation.
It's the ultimate hedge.
But wait, I have a pushback here, because that doesn't make total sense to me.
Okay, what's the hang-up?
If it's just a passive piece of infrastructure where the toll automatically rises with inflation, how did their adjusted operating margins jump to a staggering 60.8% in the first quarter of 2026?
It's a good question.
I mean, we're in a period of heavy macroeconomic friction right now. A simple, passive toll booth shouldn't be expanding its profit margins like that.
Well, that's the secret. It's not passive anymore. The answer lies in demand inelasticity.
Meaning their customers are locked in and completely insensitive to price increases.
Exactly. The Q1 data shows their value-added services revenue accelerated by 22%. Mastercard isn't just facilitating the transaction anymore.
What else do they do?
They are upselling cybersecurity, fraud protection, and these massive data analytics packages directly to the banks and merchants who are, quite frankly, already trapped on their network.
Oh, wow. So they built a toll booth. Everyone is forced to drive through it because it's literally the only road in town. And now Mastercard is successfully pulling over all the drivers and selling them premium insurance, navigation systems, and security details.
That is a perfect analogy. And because the cost of fraud on the network is so incredibly high for the banks are more than happy to pay Mastercard a massive premium for those advanced cybersecurity tools.
That makes a lot of sense.
Yeah, Mastercard is proving they can charge more and layer on all these extra services without losing a single drop of their core transaction volume.
So if they have this inflation-proof toll booth pulling in a nearly 61% operating margin, they must be absolutely drowning in cash.
Oh, they are.
So the obvious question is, what exactly does a company do with all that money when its digital highway is already fully built?
Well, they act as what the financial community calls a corporate cannibal.
A cannibal.
Yes. But to truly appreciate what that means, we first have to look at the purity of their earnings. Contrast Mastercard with, say, your typical Silicon Valley tech giant.
Okay.
A tech firm's cash flow might look fantastic on paper until you realize they are compensating their software engineers massively in stock. That's stock-based compensation, or SBC.
Right. And SBC is essentially a silent killer of shareholder value.
Completely.
I mean, if a company issues millions of new shares just to pay its employees, it actively dilutes the value of the shares that everyday investors hold in their portfolios. It's like a government printing more money. The dollars you have in your wallet suddenly buy a lot less.
Exactly. But Mastercard's SBC is remarkably tiny. It accounts for less than 2.5% of their operating cash flow.
Less than 2.5%, wow.
Yeah, so there is almost zero equity dilution happening here.
Yeah.
The cash they bring in is incredibly pure, and the returns they generate on the cash they actually do deploy back into the business, they are phenomenal.
What kind of returns are we talking about?
Their return on invested capital, or ROIC, sits above 50%.
50%. And just to ground that number for everyone, a 50% return completely dwarfs their cost of capital, which is only about 8.5%.
Yeah, the spread is massive.
In simple terms, for every dollar they borrow or invest in their own operations, they're generating these massive outsized profits that completely defy the normal laws of corporate gravity.
Right. So they have all this pure cash, and they follow a very strict hierarchy for deploying it. First, they invest organically in maintaining and upgrading the network. Second, they do stock buybacks. Third, targeted mergers and acquisitions. And finally, dividends.
And those buybacks are the core mechanism of that cannibal strategy you mentioned.
Exactly. They are systematically and relentlessly repurchasing their own shares from the open market and just retiring them.
They just authorized a fresh $14 billion for share repurchases, right?
Right, $14 billion. And they aggressively deployed $4 billion of that in the first quarter of 2026 alone.
I think we need a good analogy here to explain why this is so powerful for the investor.
Sure, go ahead.
Think of Mastercard's total value like a massive pizza. If the company takes its cash profits, goes out into the market, buys back its own slices, and then completely destroys them.
They are reducing the total number of slices that exist.
Exactly. Even if the overall pizza stays the exact same size, the slice that you hold in your portfolio just got substantially larger. You own a much bigger percentage of the total profits. That's why they are called a cannibal. They are eating themselves to enrich the remaining shareholders.
It's a beautiful dynamic if you hold the stock.
But let me play devil's advocate for a second.
Okay, let's hear it.
If they're converting more than 95% of their net income into free cash flow, and their main strategy is just to aggressively buy back their own stock, Is that a sign of ultimate financial confidence? Or is it actually a massive red flag?
How so?
Does it mean management has just completely run out of new, innovative ideas to invest their money in?
It's completely natural to view aggressive buybacks as a lack of imagination. But in the context of a two-sided digital network, it is actually the absolute pinnacle of capital efficiency.
Because the network is already there.
Right. The core infrastructure, the global rails connecting thousands of banks and millions of merchants, is already fully built. They simply do not need to build a second network.
Right, that would make no sense.
Throwing billions of dollars into risky, unproven side ventures would just be a terrible use of capital. Shrinking the outstanding share count is mathematically the most efficient way to drive up the intrinsic value of every remaining share.
Okay, so we have this highly efficient, cash-generating cannibal of a company.
Mm.
What is that money-printing machine actually worth to the market today?
Well, looking at the current valuation, at that $500 share price, Mastercard is trading at a 23.2 times forward price-to-earnings ratio, and it has a 4.1% free cash flow yield.
And those metrics are incredibly notable because they represent a rare discount.
Yeah, a really rare discount.
If you look at Mastercard's 5-year historical average, it normally trades way up around a 31.5 times forward PE. So it is currently much, much cheaper than it has historically been.
Right. And to figure out if that's actually a good deal, we use something called reverse DCF logic, reverse discounted cash flow.
Which flips the normal Wall Street model upside down.
Exactly. Normally, Wall Street tries to predict the future to guess what a stock should cost today. Reverse DCF flips that entire process. It looks at today's $500 price tag and asks, what specific future is the market baking into this price right now?
Then what does the math say?
At $500 a share, the math shows the market expects Mastercard to grow its free cash flow at about 9 to 10% annually over the next decade.
But historically, their 3-year revenue compound annual growth rate is hovering around 11.8%.
Right. So the market is actively pricing in a structural slowdown.
Wow.
If we triangulate the intrinsic value using a few different methods, we get a very clear picture. A historical mean reversion puts the fair price around $620.
Okay.
The Wall Street analyst consensus target is roughly $642, and a very strict conservative owner earnings model yields about $585.
So blending those together basically establishes a strict buy zone between $465 and $515.
Yep. And as of today, it is sitting right at $500, dead center in that buy zone.
But this brings up a glaring contradiction. The market is essentially betting against Mastercard's own proven track record right now.
They really are.
I mean, they are pricing this stock like the hypergrowth is absolutely going to slow down. Why the sudden pessimism? What is Wall Street seeing that everyday investors might be completely missing?
The market isn't doubting Mastercard's past execution. They know the toll booth works. What they are completely terrified of is the shifting regulatory perimeter.
Which brings us to the red team challenge, the pre-mortem.
Exactly. What are the specific kill criteria that could destroy this entire compounding thesis?
And the biggest crack in the fortress walls right now is the massive June 2026 regulatory action.
Yeah, it's a big one.
We are talking about a $38 billion multi-year settlement that effectively caps domestic swipe fees. And just to be clear for everyone listening, we aren't talking about the politics of this. We are just looking at the structural reality for the business.
Yeah.
Regulators have essentially put a hard governor on how much Mastercard can charge merchants within the United States.
And that settlement leads directly to the core bear case, which is the utility threat.
The utility threat. Let's dig into that.
Earlier, we talked about how Mastercard charges an ad valorem fee, taking a percentage of the total transaction.
Right.
The absolute nightmare scenario for this stock is if that $38 billion settlement triggers a wave of global price-fixing crackdowns. If regulators worldwide decide that financial networks can no longer charge percentages but must shift to a flat fee model.
Like, say, a mandated 3 cents per transaction, regardless of whether you buy a pack of gum or a massive flat-screen TV.
Exactly. If that happens, Mastercard instantly becomes a regulated utility.
And if they are treated like a utility, we would see a massive multiple DARE rating.
A huge D rating.
Let's translate that. Even if Mastercard continues to make billions and billions of dollars in those flat fees, the market will completely slash their valuation. The stock could compress from that 23 times PE ratio down to a 15 to 18 times PE ratio.
Very easily.
The stock price could literally crash and become dead money for years simply because the promise of future hypergrowth has been legally capped.
And beyond domestic regulation, there is also a severe geopolitical threat.
Sovereign nations building their own rails.
Right. Sovereign nations are actively building their own digital payment rails to bypass Mastercard entirely. The two most prominent examples are Pix in Brazil and UPI in India.
We really need to explain how these actually work because they are fascinating. Take Pix in Brazil. It's a state-run instant payment system.
Yep.
It allows the consumer to literally just scan a QR code at a coffee shop, and the money instantly transfers from the consumer's bank account directly to the merchant's bank account.
Completely cutting Mastercard out of the loop.
Out of the loop entirely. There is no physical card, there is no swipe fee, and Mastercard gets zero cut of the transaction. These state-subsidized networks put a very hard ceiling on the global cross-border volume Mastercard can capture.
It's a huge existential threat.
But let me push back on this utility comparison for just a second.
Okay, sure.
If I am a local water company, my hands are entirely tied. I cannot invent a better type of premium water and suddenly charge my neighborhood double for it. Water is water.
Right.
But Mastercard can innovate. We already established they are successfully selling advanced cybersecurity and fraud protection.
Yeah.
So is calling them a utility just a worst-case scare tactic by Wall Street?
It's a very valid pushback, and honestly, the services division is exactly how Mastercard intends to survive this.
By leaning into the software.
Yeah. While the core transaction rail, the actual movement of money from point A to point B, might face utility-like price caps, the services built on top of that rail remain completely unregulated.
I see.
Governments might cap the toll, but they cannot cap the value of the proprietary data analytics, the open banking software, and the AI fraud algorithms that Mastercard layers over the transaction.
So to avoid becoming that stagnant dead money utility, Mastercard is actively mutating.
Mutate isn't the perfect word for it.
They realize they have to move beyond just being the physical plastic card in your wallet. If you look at their 5 to 10-year strategic outlook, they are aggressively positioning themselves as the foundational software layer for the future of value movement, whatever form that takes.
They are actively laying new track right now. Just look at the Q1 data. It notes a $1.5 billion acquisition of a company called BVNK.
BVNK.
Yeah, and this is a massive direct play to own stablecoin infrastructure. Standard fiat currency transactions can take days to fully settle between international banks.
Which is wild in 2026, by the way.
It really is. But stablecoins, which are digital assets pegged to a currency like the US dollar, settle instantly on the blockchain. Mastercard is integrating these digital asset rails directly into their traditional network, so they can process crypto-based payments just as easily as traditional credit.
And then there's the release of a product called Agent Pay.
Oh, this one is fascinating.
It's designed to facilitate automated AI commerce. The core thesis here is just wild. They believe that over the next decade, even if regulators force the fee per transaction down to a fraction of a cent, the sheer absolute volume of transactions will multiply exponentially.
Because humans won't be the ones making all the purchases anymore.
Exactly. Let me make sure I'm fully grasping this strategy. They're essentially hedging their very existence.
Yes.
If AI agents or instant crypto transfers completely disrupt how human beings pay for things, Mastercard is just buying up those new technologies right now. They want to ensure that whatever the future of money looks like, the disruption still has to run through their toll booth.
They are adapting the toll booth to handle flying cars instead of just minivans.
I love that.
They accept that the physical form of payment will change, but they're betting that the need for a secure, trusted, globally recognized network to verify and settle those payments will only increase as the velocity of money speeds up.
Wow. We have covered a massive amount of ground today. Let's synthesize exactly what we've learned.
Sounds good.
Based on the real-time June 2026 data, at $500 a share, Mastercard is a masterclass in scale economics, trading at a rare historical discount. It is an unbelievably efficient machine that turns near zero marginal cost revenue into pure cash.
And then uses that cash to cannibalize its own shares, systematically driving up the intrinsic value for whoever is left holding them.
Right. Yet, it is also a global fortress currently under heavy siege. It is actively battling regulatory friction, massive legal settlements aimed at capping its domestic fees, and the very real threat of sovereign nations like Brazil and India building their own bypass roads.
And to fight off the threat of multiple degrading and becoming a low-growth utility, they're aggressively building the infrastructure for instant stablecoin settlement and AI-driven commerce.
It really changes how you interact with the world around you.
It definitely does.
The next time you tap your card or wave your phone over a payment terminal at a grocery store, realize you aren't just engaging in a simple, isolated purchase. You are actively participating in a highly contested $442 billion global toll booth that is rapidly trying to adapt to the future of technology just to protect its moat.
Every swipe is just another data point flowing through the fortress walls.
Which leaves us with a final, slightly mind-bending thought to ponder. We talked about agent pay and preparing for a world of AI commerce. Think about the implications of that for a moment.
It's pretty crazy to think about.
If AI bots start acting on our behalf, conducting thousands of microtransactions a second to optimize our software subscriptions, negotiate our utility bills, or manage our supply chains, does human behavioral psychology even matter to Mastercard's moat anymore?
What?
Does your personal brand loyalty to the shiny logo on a piece of plastic mean anything at all? Or in the future, are financial networks just going to be marketing their reliability and processing speed directly to algorithms?
That will absolutely be the ultimate test of their moat. What happens when the decision to use the network isn't made by a human being at a cash register, but by 1,000 lines of code executing in a microsecond?
If the walls of this financial fortress were originally built to keep out human competitors, we are about to find out if they can withstand an automated, algorithmic future. Thanks for joining us on this deep dive. We'll see you next time.